Ladies and gentlemen of the crypto space, we're live on a Wednesday, April 13th at 11:51 a.m. Cash, cash, cash. Quite misunderstood, and I'd like to discuss my contrarian perspective of everything, because that's what we always discuss. But we're going to talk about cash today. So, you know, we still have a lot of deprogramming to do. People think of maybe their youth, as they got older, high school, so on and so forth, and you have a bank account and you work and you put dollars in the bank account and you spend dollars and everything is dollar, dollar, dollar. So we've been programmed forever to think of we have to have dollars and we have to have more dollars. So we have to save, we have to spend less than we make. But cash is an asset. And yes, you need so the point I'm trying to make is cash in a bank account needs deprogramming. What we really need to start thinking of is our life in terms of our assets, and cash is just another type of asset. And we have to think of a portfolio, not a bank account, not just a quantity of cash. So, I've said things about portfolio structure, like you could think of stablecoin components as a savings account. So that just helps us uh, frame the portfolio in historic terms that the general public may be more comfortable with digesting. But really, it's the portfolio. What we have is that's all we have. So if you like a bank account, that's a portfolio. It's a portfolio that's 100% cash. So you guys see what I'm saying? You guys see what I'm saying? We're working with portfolios. We have a balance sheet and we are custodians of this balance sheet and we deploy cash, we buy things, but that is also something that I want to deprogram. People see cash as something to purchase something else, which, yes, obviously, for the better part of crypto history, that and just stocks in general, people are like, I want to buy a stock. How much cash do I have? I want to buy a crypto asset. How much cash do I have? But now, the way the crypto space is heading, I don't think that's the case anymore. I'm seeing cash as functional. So what does that mean? So prior to 2020, cash was literally just to buy crypto assets, stocks, whatever. And maybe, a good part of 2020, 2021, and 2022 has been shit thus far. Cash has been quite functional, but it was experimentation stage, meaning we're just starting to digest what the heck was going on in DeFi, what the heck was Curve throwing around with these LP positions, and really, if you look at the Curve white paper, it's designed to be banking, and that's extraordinary the way they talk about it in the white paper. And Aave really is a money market, but in technological implementation, it is what it is. So these are places to put cash to make them productive. Now, clearly, from a consumer price inflation standpoint, you want your cash to outperform price inflation. And, you're looking at shadow stats, you're talking about 15, 20% consumer price inflation in through any historic lens. That's really what you need to outperform um, consumer price inflation. So that's a bit of a burden. So, how do you do that? How do you do that in a well structured portfolio? So, cash, obviously, you need to service your debts, your overhead, pay bills, so on and so forth. So, you need a part of the portfolio that's always cash. You need it to be functional, not deployed in asset form, because then you have the cash portion of your portfolio facilitates mitigation of volatility. So, I guess what I'm a part of what I'm trying to express is folks look at the portfolio too granularly. Is a particular asset up and down? But I want people to focus on the portfolio balance. So you want the value, the nominal value of it to go up. Now, there was a tweet I posted maybe a couple weeks ago. I was like, which is worse, to not make money or to lose money. So if your portfolio balance 100 grand and it's going up 5 grand a month and it has a large stablecoin component, it's going to be more stable than a portfolio that's just assets. And you're going to be more comfortable with it. You're going to be able to sleep at night. And it's going up. If it goes up 5 grand a month, that's 5% a month. That's an extraordinary rate of return. That's clearly outperforming inflation, consumer price inflation. So that is probably one of the more important things I would hope to express to everyone. Um, Bank account really is a portfolio. It's just a cash only portfolio. And in the crypto space, we have a structured portfolio filled with assets and stable coins in balance. A portion, proportionality, 40% stables, 60% assets. So the art of capital management is these types of perspectives and managing your portfolio such that it's stable and going up in value. So if there's too much asset exposure, it's going to be volatile and it's likely going to depreciate excessively. So I'm probably heading into the next very bullish cycles thinking very differently about the stablecoin part of the portfolio. What the percent will be during the most bullish of times will probably be a large part stables. Now, obviously, I may take advantage of capital gains opportunities where there's a very obvious trend formation, but that's breakout trading. So you play the breakout, you capitalize, it goes right back to stables. You want a percent of the portfolio, and I'm feeling more and more comfortable saying a large percent of the portfolio in stable form. So clearly, in times of insanity like we're experiencing in this market, do you guys see the whole screen? I don't think you see the whole screen. Do you guys, guys don't see the whole screen. Something's wrong with this. Let me check. Oh, that explains it. I'm fixing it. Sorry, guys. There you go. So, in times of insanity like we're seeing right now, the high stablecoin percent of the portfolio makes sense. It absorbs the volatility, and but the change of mind, or at least the iteration of the evolution of my mindset, is that why would I change the stablecoin percent in bullish times? Because I'm getting exuberant? Does the captain get exuberant? Am I going to be like, ooh, FOMO? Am I going to make a lot of money? I'm going to be rich? Am I going to do that? I'm the damn captain. No. So I need to think of contrarian ways, things that most people would not think, and how to engage with these markets rationally. So the more and more I think about that, obviously one of the most obvious ways to be contrarian is to have a large stablecoin part of the portfolio during extremely bullish times. So I'm not a trader where the whole portfolio is cash, you're getting in and out of assets, and you just capital gains. There's a lot of assets that I have a high opinion of. Clearly, I have the large convex position. I have the legacy CRV position, VECRV. Frax, FPIS is crazy, and we have the diversified portfolio. We've talked about the components of the portfolio, and the folks over on Discord are able to see the components, the larger components of the portfolio. So I have my assets, and I know that they're going to be volatile. But because they're going to be volatile, I'm feeling more and more comfortable with the large component of the portfolio being stables. What's interesting, it's probably most interesting, and a good reason why I've been thinking of stablecoins like this heading into whatever next bullish period of time it is, whatever the hell it is. Clearly, we're looking at the 10-year, and I don't think there's going to be a bullish time in the markets for quite a bit. This thing looks. The implications, this is bond bullish. The implications of bond bullishness, I'd have to digress into an entire conversation what they are. But this is just extreme volatility right here. So the reason why I'm feeling more and more comfortable with a large component of stables in a bullish market is really two protocols. Two protocols that I think are going to really change everything. Bancor V3 catalog finance. Um, and clearly, protocols like Stargate and other cross-chain messaging protocols that are able to utilize things like stables in a very productive fashion. But really, the phrase is productivity. If your stablecoins can be productive, earning 10, 15, 20%, oh my God, those are massive numbers. 5% would be is extraordinary in legacy finance terms. Then that means your stablecoins are providing stability to your portfolio. They're also being productive. And that means they're not just idle. That means they're not just doing nothing. That means you're optimizing the implementation of the portfolio. Too often, folks go all in, and folks are fearful of having a relatively large quantity of stablecoins. But that's because folks have that legacy mindset that I started the stream talking about. The bank account and the what do you do with cash? You buy things, but maybe not. Think about it in terms of a portfolio. And what is the best structured portfolio? If you say your portfolio is a bank account, what do you want to do with your bank account? You want the bank account to go up in value over time. You want the bank account to go up in value large quantities over time, but that also introduces risk. And if your bank account is going up multiples, it could also go down multiples. So that's why the well-structured portfolio, 100 grand turns into 105, turns into 110, 120. At the end of the year, you have $160,000. Holy crap! The money in your bank account, your portfolio, grew from 100 grand to 160 grand. Plus, you're working and doing, living your life and doing all the stuff we normally do. Except your bank account just grew 60% in a year. If you could do that with a large quantity of stables in your portfolio to stabilize things, that sounds like the most rational way to engage with markets. So, figured I'd hit you guys with this kind of topic because we're in this period of time where we have extreme uncertainty, this ridiculous head and shoulders on the 10-year yields, which means bonds are primed to go to the upside. As yields go down, bond price goes up. So this is like max drawdown on bonds. Where now it's really all you could go is up on the bond price and down on the bond yields. So this is the time to think about this stuff. We're at a crossroads of trying to figure out which direction the system is going to head. I speculated when we were breaking from historic trend that there was a couple of things, one of two things. Either bonds continue to be bearish, but there's plenty of reasons for bonds to be bullish. And the reason why is because most people don't look at how the system operates. The global financial system, they look at stocks and crypto. And that's the last place to look for the directionality of markets. Or even, in fact, the crypto space and the stock markets around the world are nothing. They're nothing. They're a fraction of a percent, well, not a fraction of a percent, but single digit percents of the global financial system. The global financial system is OTC derivatives, which are collateralized by sovereign debt, primarily U.S. Treasuries, and the euro dollar bond market. So those are the markets to look at to know where the system is heading, not necessarily when, but overall pressures in the system that are pushing it in one direction or another. So when you see a reversal in bond price action like this, my sentiment is, I'll digress a little bit, that uh, OTC traders that use treasuries as collateral were like, oh, this is the cheapest treasuries have been in 41 years per trend. Well, not 41 years, but adjusted for trend. And this is max drawdown on bond price. So they were able to purchase a large quantity of bonds super cheap. Oh, cheap collateral. And now they collateralize their OTC positions and oh, the bond price is going up. So now they collateralized it with a depreciating asset. So we know the deal. If you throw Ethereum on Aave and you're at 2x health, and then Ethereum doubles in price, you're at 3x health. Okay, so we understand the way these OTC or just collateral positions in general work. So I believe that makes sense. So we could actually look to the crypto space to understand how these global financial legacy structures move markets and push markets around. And just remind you guys, the last place to look to understand the direction of the stock market is the damn stock market. If you want to understand where Bitcoin's going, up or down, it has nothing to do with Bitcoin. It's all bonds and OTC derivatives and the Eurodollar. So when you see moves like this is some serious volatility. We haven't seen candles. When's the last time we saw candles like this? And this is 2 days. The last time we saw candles like this, a bond bullishness, was March of last year. Pretty much March of last year. Extraordinary. So this is pretty unprecedented times in all regards. Let me answer you guys questions. Let me see if I could help out. Clearly, these are my thoughts, but you guys got thoughts too. Dan's in the house. Always a pleasure. Morgan, good morning. Andrew, Danny, the Tox King. I do got a nice little set of Tox, don't I? Foo Bear, Killis is in the house. Dan, Andrew, One Curious View. Hey, Noah, with FPI launch, what percent of your portfolio will be stable versus FPI? Well, I'm not going to be getting into FPI just yet because it doesn't have a functional use case. But when FPI starts to be paired with stable coins, so traditional stable coins, then it has liquidity, and then we could assess the stability of its value and its relative functionality and reliability. So it's not prime for me yet. So obviously my preferred stablecoins are USDC and GUSD. GUSD above all, because GUSD you just transfer to Gemini and they are one-to-one with dollars, no matter the DeFi price point of GUSD. So we'll see how things play out. So I'm a very high opinion of FPI and the airdrop on FPIS. I haven't claimed it yet because tax obligations. I have to be graceful with that nowadays, but it's a very large airdrop. Check this out. With the price point, quite an extraordinary airdrop. I think it's sitting at about $11. I think the airdropped about 170 grand or so. This might be one of my This is the largest airdrop I've ever gotten. Wow. And people, and it has a lot of volume, so it's being traded. So it's decent amount of liquidity, nice market cap, circulating market cap, 105 mil. So you never look at fully diluted market cap. That's the most misleading metric. It'll drive you absolutely nuts. But it'd be nice to see this get up to a half a bill circulating market cap. That's pretty cool. And then they could dilute it from there and probably decrease circulating market cap because more in circulation will cause depreciation. But that's most important. The fully diluted market cap will drive you nuts. It's the circulating market cap that's most meaningful. So it's 100 mil. It's a heck of a price point for a newly launched asset. So there's no reason you can't get a couple of multiples out of this. And clearly we got it at the bottom at about 4 or 5. I think that was the bottom. Yeah, about $4, $5, 5.20. And so it's doubled in price in 2 days. No, a day and a half. So the 12 yesterday at 6 p.m. Yeah, 100% in 24 hours, less than 24 hours. Quite extraordinary price action. It looks like people are seeing the significance of the protocol. I think everyone always saw the significance of the protocol. It's a newly launched asset, massive airdrop, and they were thinking that it was going to depreciate significantly, which it did, but it didn't. The launch candle is always irrelevant. A little bit of chop at the beginning, some run up, and then clearly airdrop folks liquidate. Inverse head and shoulders here. Pretty solid inverse head and shoulders at the bottom. Go figure. That would have been a nice entry. You guys see that, right? Boop, boop, boop. Solid inverse head and shoulders. So I like the way this is heading. I have a position. It was airdropped. I have absolutely zero need to reallocate my cash position. There is very few things that will get me to reallocate from my cash position. And I've become very comfortable with knowing I don't need exposure to Bitcoin or Ethereum. Bitcoin does what it does. Ethereum's going to do what it's going to do. And if Ethereum does what it's going to do, the assets that I have in my portfolio are going to run multiples of Ethereum. It's like leveraged Ethereum positions. So this plays into the narrative of overexposure to a narrative. A narrative. So too often folks are overexposed. They hold too many assets. because you got to remember, let's talk about the curve narrative for a second. If you have curve, it's controlled by convex. If you have convex, it's controlled by frax, and as well as the others. Badger has a big piece. Um, Citadel is going to be absolutely interesting. But Redacted's got a big piece, and Luna's picking up big pieces of convex as well. So that it's over. If you have excess of those assets, you're overexposed to the same narrative. So guess what? If you have those assets, you're indirectly exposed to the Ethereum narrative. Ethereum does what it's going to do. Your curve narrative assets are going to outperform. So too often folks are overexposed. So, over the last couple of weeks, I flip flop a bit with regard to an F position. Currently don't have it, and that's fine. And I'm realizing that Ethereum position folds into the curve narrative. It folds into what I've been talking about overexposure to any particular narrative. And I'm actually very excited for stablecoin yields presented by Bancor V3 and Catalog Finance. Clearly, Stargate is not sustainable with regard to yields. They've been diluted and the emission schedule is reducing. So maybe it's not the optimal stablecoin opportunity, but if you can get 5, 6, 7, 8, 9, 10%, that's a heck of a stablecoin position. Beats the hell out of a bank account, and it provides stability to the overall portfolio. And you got to remember, just because your stable coins are getting 5, 6, 7, 8%, 9, 10%, or whatever the hell you can get risk considered, your other assets in the portfolio, it's all one thing. It's all part of the portfolio. It's all your bank account. So as the volatile assets increase in price, that's the same thing as your bank account going up in value. So I think folks are underappreciating solid percentage points on stablecoins, and they're thinking they need to be deployed to an asset in order to be effective or best used. And I'd argue that's not the case. I'd argue the volatile assets in the portfolio are able to produce appreciation and produce income to grow the overall portfolio. I guess the best way to express it is people focus too much on cash as a negative instead of its properties to balance the overall structure of a portfolio. And they focus too little on the overall portfolio, and the goal of the overall portfolio is to go up, only up, if possible. And you want to make less money rather than more, because that's a contrarian thought. That means there's going to be less risk. And if you have less risk, you're more likely to go up than down. And this all plays into a well structured, risk considerate portfolio management strategy. Lewis is in the house. Hey, my brother. In absence of a brand new protocol or platform specifically outlining the tokenomics, how can I ascertain whether the token will be inflationary or deflationary, please, sir? Well, you need the white paper. And then it gets into like contract evaluation to validate claims, which is sophisticated. More often than not, there's big risk because even if you are able to decipher the contract implementation, there's edge cases, and you don't really know how a contract is going to perform until it's thrown into the wild, or unless there's like an endless suite of unit tests exercising all possible variations of a function's execution. But that's possible. I mean, Curve literally has been live without a hitch since launch. So that's quite extraordinary, considering the sophistication of their algorithms. Hope that helps. There's a lot of nuance and opaqueness in the launch of an asset. Killis, what is your opinion on minor platforms like Ruby and Baked Beans? I have no idea. Never heard of them. I guess that answers it. I've just never heard of them. CJA, that's smart. Why, thank you. I'm blushing. Give us one more question. Always, what's better, stable staking platform nowadays, in your opinion? Well, obviously, if you're going to think about curve narrative, curve convex, but convex, that this people are turned off by these low percentage points. But that's I think that's wrong. I think we need to reevaluate what's right and wrong. And the point of a stablecoin position isn't just to be disappointed that you're not making 50% of the money, 100% of the money in an asset that goes up 100% in a day. The point of a stablecoin position is to balance and stabilize the portfolio. Look at the whole portfolio as a position, as your bank account, as I'm trying to express through the entirety of this stream thus far. Stop looking at stablecoins as cash, but start trying to look at the whole portfolio. And the more you respect the whole portfolio, the more the whole portfolio will respect you. Like, let's see, what catches my eye? Let's do a quick little fun one. What catches my eye is something that would be suited for my stablecoin position. GUSD, 8.36%. This is with 3 curve, DAI, USDC, USDT, and GUSD. This catches my fancy. Frax catches my fancy. MUSD catches my fancy. 1, 2, 3. I'd skip over UST. I believe in the Luna narrative. I like it very much. I just don't need exposure to its stablecoin. Now, I need to wait for the market to reassess, for it to be comfortable. Doesn't mean I have any distaste for what they're doing. In fact, I actually have a high opinion of what they're doing. I understand it from a conceptual standpoint as well as a monetary policy standpoint. LUSD, interesting, because that's an Ethereum collateralized stablecoin. So that's cool. So we found thus far 4 stablecoin positions that produce 7.24%, 7.85, 7.84, and 8.36% return on the money. That's an extraordinary percentage point, which probably will be diluted in the coming years. But hopefully, when it's by the time it's diluted, you're not going to worry that you're getting 1, 2, 3% because you know what'll happen with your volatile assets. That's about it. I'm not going to go further down. You're down at 2%. That's probably not going to catch my eye. I'd probably look for other opportunities. But we found 4, stablecoin LP positions that are quite interesting. It's a heck of a percent. Take that, HSBC. I am Groot. They were just mentioned on Deuce Finance, last Twitter Spaces. I like what Deuce is doing. I like Laffa. I've talked with Laffa and on Telegram as well as a couple of interactions on Twitter. So, you know, that's it. I like what they're doing. Ethan, good morning, Noah. Ritari, how do you evaluate the risk curve of stablecoin yields? Okay, so there's a risk profile associated with each and every stablecoin. There's not much risk profile associated with USDC other than the government freezes someone's contract access. There's even less of a risk profile associated with GUSD. And I don't think there's much risk profile at all with regard to the price point of USDC or GUSD, because you'd always transfer USDC to Coinbase and get $1. You could always transfer GUSD to Gemini and get $1. There's a risk profile associated with Tether. USDT, I like what they're doing. It's basically a euro dollar. They're collateralizing with debt positions. And bear in mind, the notion of what a stablecoin is quite interesting. Because the value of the stablecoin is really based on arbitrage only. It's literally just based on market actors and incentives to arbitrage the peg. So you bring it back to peg, you're going to make some money. So that's a good part of what stablecoins are, but it's also psychology and lendiness. And lendiness self-reinforces over time. So the longer and longer USDT is in circulation and growing and has a large treasury of whatever shit debt they want to fill it with, it doesn't matter. It's collateralized and it's functional. And even if there's a large amount of defaults on the books, that doesn't mean much with regard to the dollar value of USDT in the crypto space. That's all arbitrage and market actor incentives to capitalize on peg restabilization, peg restoration. So I don't have much hesitation to allocating capital to Frax here, which is Frax and 3 curve, which is Frax, USDC, USDT, and DAI. So MUSD as well. MUSD is basically a basket of stablecoins, all the stablecoins that you can imagine. So MUSD is a very diversified. So it's a risk adjusted stablecoin that probably has more risk consideration than even GUSD. It's spreading the risk amongst all stablecoins. So Meta made a hell of a product with their MUSD, and the glorious GUSD cranking 8.37%, projected at 11.85. Huh. That's pretty interesting. I'm gonna have to make some considerations. SUSD is pretty cool too, because synthetics I think will make a comeback at some point. Um, Quantified. Have you cooled off on your Badger Play cap? I have not. Meaning, I think the narrative that I see with Badger and Citadel is spot on. Am I in a position to want to take risk? No. Do I want to take any risk with the amount of stablecoins I have? Probably not, because if I purchase anything, I'll have less stablecoins, but I want the amount of stablecoins I have to grow just a little bit more, and I want to put them to work. I think it's a critical amount of stablecoins, and I consider it a very powerful position. I think it's going to be very powerful in stabilizing the overall portfolio, and it's going to be very productive. I'm going to be able to put them to work to generate a very nice cash flow. Um, and clearly, that's very contrarian. I know, because most people think stablecoins are for buying things only, but I think they're a very productive asset when you have enough quantity of them. The big twat, my man, just saying your name. My man. Hey, Noah, I know you're not too hot on the NFTs, but did you check out the interview with Raul did with Punk6529? I'm hot. I haven't seen the interview. I love Raul, but I'm hot on NFTs. I don't care about them from a capital gains perspective. I've literally never sold a single NFT. I've never sold a single NFT, but I got a heck of an NFT portfolio. Last I checked, I think my NFT portfolio is like 200 grand, give or take. So food for thought. But every NFT I've ever bought, I expect them to be worthless, and I have lots of nice stuff that I appreciate, and maybe one day other folks will appreciate them too. I pretty much bought them to so other people can't buy them. Um, so I'm very hot on the NFT space, especially from a technology perspective, like the notion of encapsulating state data in an NFT. So NFTs go way beyond like OpenSea from a technology perspective. It's basically a state management tool, like what Solidly did, where your deposit positions are fungible NFTs, or Uniswap V3, your deposits, your LP positions are not fungible, but portable NFTs. So that's the deal with NFTs. One curious view: isn't it less risky to allocate a portion of the portfolio to the base layer? CVX and Frax could fail, while F does not. Well, you just pick three assets: CVX, Frax, FXS, but Frax is the stablecoin, where or Ethereum. Well, Ethereum is going to be they're all going to be extremely volatile. What is risk? Risk with regard to it actually continuing to exist. I think all three of them are going to pretty much continue to exist. It depends how you define risk. I think you're defining risk as volatility. So I expect all three of them to be quite volatile, and I don't think it's the best mental exercise to determine which one is going to be more volatile or less volatile. What's pertinent is CVX and FXS is like leveraged Ethereum. If Ethereum outperforms, those assets will outperform as well. So in that regard, they warrant a smaller position in the portfolio, because if you're I said this a long time ago. You want the stuff that's going to run multiples, that's going to appreciate in price over the years, to be the smaller part of the portfolio. And like Bitcoin, that can only go like 5, 6, 7, 10x in 5, 10 years, whatever. You need that to be the larger part of the portfolio, because you need more of the stuff that moves less in order to keep the overall portfolio in balance. So, my perspective on the portfolio has changed over the years. But I did have this thought a long, long time ago in a galaxy far, far away that it's allegiance to the portfolio, not to a particular asset. So you want the portfolio to not outperform too much. You want it to be stable. You want the balance to be right such that one asset is not moving up faster than the other. And that always played into portfolio balance. So obviously in this downturn in the financial system, I'm giving some extra thought into old ideas and how to fold them into new, more innovative ways of thinking of the market. And I think we've had some nice evolution, literally just on this stream, about how to think of a portfolio. You guys got to remember, people are like, what do I buy? What do I buy? That's not what leads to success. What leads to success is thinking about the portfolio and the portfolio structure, which is not necessarily what to buy. Think about it like this: it's like a tennis player. I don't know how many people play tennis. I could do the same with golf or whatever. So when you're swinging your racket, you're watching where the ball is going to go. You're not watching the racket hit the ball. Or maybe it's the opposite. Or golf, your head is down and you're watching the ball contact um, the golf club. So you're not. You, I guess the point of this bad analogy or bad story is folks often look at the wrong thing, and that is what more often than not gets in the way of success and outperformance. Hope that helps. Maybe that's a good idea, or maybe I could do better next time. Boo Bear, what about stability of the APR? There are no measures. No one even does time series charts on the APR. It's frustrating to spend money to get into a position only to get diluted. My friend, I guarantee you, anything that you think is stable APR will get diluted over time. Every APR percentage point you see in the crypto space will be lower next year. It will always be diluted. Why do you think a bank account pays you 0.01%? As capital flows into the DeFi space, it's going to get diluted. Everything, no matter what. Killis, thank you very much as well. JL, hey Noah, in is the 10-year stopping its upward climb bullish for risk assets, or is this just momentary slip and bond yields will keep climbing? Risk assets are not correlated to yield directionality. It's not about bullishness or bearishness. Those are very overused terminologies. What we have is extreme uncertainty, and bullishness and bearishness. Direction of the stock market in the crypto space is all about free liquidity. Obviously, if there's excess liquidity, people are going to buy a lot of, let's say, crypto, a lot of Ethereum. And then it builds momentum. As someone big buys, someone else finds money and they buy. So a market is like a recursive feedback system. So it takes a lot to shift momentum. And right now, the momentum is against appreciation. Um, Markets and periods of irrational exuberance are like waves that crash across the emotions of market actors. And you have periods where the emotional sentiment is FOMO and excitement and adrenaline, and that spreads like a virus. It's viral. And that gets everyone in concert pushing the market in the same direction. So right now the market structure is broken. Market actors have fear and they're not deploying capital. So it's not that correlation and inverse correlation are very nice. They don't tell you where the market's heading. Like yields come down on 10 years, crypto space goes up, stock market goes up. It's more than that. This tells a story. This tells a story, this 10-year chart, really about collateral and it getting above historic trend, uh, presented as cheap collateral to someone in the market that needs it, which is probably an OTC derivatives trader. They're like, oh, all right, I want to get into a trade. I'm going to buy some cheap collateral. It's the cheapest it's been in forever. So they bought cheap collateral. So if we see a break, like a massive, massive candle that goes up to like 3%, all right, fine. Then we have another story to tell. But if you see a very strong downward candle on 10-year yields, then that's bond bullish, and all of a sudden the market's buying bonds. Maybe that tells us that large actors are repositioning into bonds, and maybe they're expecting significant volatility in risk markets, crypto space, and stocks, and they're positioning themselves in a secured fashion. So what happens? Then it spreads, and someone else does it. It spreads, and someone else does that. And that's what contagion is, where enough actors do it that breaches a critical threshold where the average market actor starts to go along with trend. And then you get a cascade, you get liquidation cascades, you get strong, rips to the downside, and you get short cascades, short liquidations as well, and you get rips to the upside. Hope that helps. It's not an easy story to just look at correlation and to assess the potential directionality of a specific market. Each market really tells a story, and you have to understand where the market fits into the global financial system. Caleb, last question for the day. Port balance versus relative, sir. Tread carefully. Portfolio balance versus the relative. Uh, I don't fully understand it, but I like it. I think you're heading in the right direction. We're going to wrap it up for today. 45 people in the stream, 12 likes. We can do better. Wednesday, April 13th at 12:32 p.m. As always, I thank everyone for joining me today. It's been a wonderful day. It's nice to be back after last week at the Bitcoin conference, but now I'm back on stream, able to express a lot of these ideas. I hope it helps everyone as much as you help me. After party on Discord with the most rational community in the entire crypto space. I love all you guys on that and gals on the Discord. We really make a difference. You guys help me tremendously try and figure out what I'm doing, why I'm doing it, and how I'm doing it, and I hope I help you guys out just the same. If anyone needs any one-on-one, noahseidman.com. I'm happy to help. There's a calendar system on there. I will catch you on Friday. I wish you all a wonderful day. I'll see you then.